Right, so question number 5. So on the exam, you don't really need revenue and expense and everything else. You just need to, you can just start with accounting and profit. That's why that error really didn't matter on the exam. So accounting profit is $2 million. So how do we get from accounting profit to EVA? So for our purposes, we're only going to add 2 things back. We're going to add back depreciation. We're going to add back costs of debt. Why depreciation? Because that's a non-economic.
It's a non-cash charge?
Yeah, it's non-cash, non-economic. It's kind of just a rational allocation over time. We have that cost of debt because we want to separate cost of debt and put it in cost of equity as part of cost of capital. All right, so our depreciation is given in the problem in a footnote. Your expenses included $4 million depreciation. This $8 million is just ignored. The fact that she's paying herself $8 million is perfectly fine. There's nothing wrong with that. So we're going to add $4 million back, and interest expenses $4 million. We're going to add $4 million and $4 million back. And what does that give you? Remember that term? Economic profit. So their economic profit is $2 million plus $4 million plus $4 million. So her economic profit is $10 million. We're going to take that, and we're also going to do cost of capital. Cost of capital is going to be cost of debt and cost of equity. Cost of debt, we've already got, right? It's $4 million. So we just got to get cost of equity. What is her cost of equity? Well, she's going to invest $30 million for her own money, and she needs 18%. Y'all see that? $30 million for her own money, that's her equity. And she has a required return of 18%. 30 million times 18%. So her cost of equity capital is $5.4 million. You can over here, if you want somewhere, you can do capital employed. So she had $30 million of her money. How much was the bank loan? She borrowed $50 million from the bank at 8%. That's where that $4 million came from, like $50 million times 8%. So she's going to borrow $50 million from the bank. So how much capital does she have employed? $80 million. So you might just put that next to your cost of capital. So what's our total cost of capital? You just add those 2 together. What's her EVA, economic value added? You just take your economic profit, minus your cost of capital. She paid 6%, 600,000, and then her EVA spread, you just take that 600,000 and divide it by 80 million. You get 75 basis points EVA spread, or 0.75%. Be careful that you do it both ways, because the problem says that. Do your economic value in both dollars and percent. And so we've done that. It's $600,000 in dollars, and it's 75 basis points in percent. And again, this is a really simplified problem, but if you understand this, you understand EVA. It's really not that much more complicated. The complication with EVA is all those adjustments you make to net income. And every firm has their own. USA had like hundreds of them, which is a massive spreadsheet. So that's the only thing complicated. Other than that, it's not.
How do you get the spread?
Huh?
How do you get the spread?
So the spread is, that's why you need this capital employed. She borrowed $50 million and you used $30 million of her own money, so that's $80 million. So you take the EVA and divide it by that $80 million. All right? So that's 75 basis points. Other questions on this one?